Okay, thank you. Again, my name is Neil McDonald. I'm a solutions consultant with Binary Stream Software. I am a CPA, CMA, been an accountant for 23, 24 years now. One thing I will throw out there, though, ASC 606 is complex. It's not an easy standard. It's a couple hundred pages if you read the documentation. Despite the fact that I am a CPA, I'm not your CPA, so just do your own research, take the information you're going to get today, back to your accounting team, back to your CPA, back to your legal team, and make sure that you apply the standard as it fits your business. So what we're going to talk about today is, first of all, what is ASC 606? We're going to look at the 5-step recognition model that's clearly delineated in ASC 606. We're going to talk about some areas of concern. If ASC 606 applies to you and you're looking at adopting it, what do you need to know? What are the gotchas that are going to really get your attention and that you need to work your way through? And finally, how can you be ASC 606 compliant in Dynamics GP? And there's a couple ways. We can talk about the hard way and we'll talk about the easy way. Obviously, as Chris mentioned, we will have a Q&A at the end, but feel free to type in any questions throughout the webinar. And Chris, if something comes up that looks like it's a very pressing question relevant to what we're talking about at the moment, certainly feel free to interrupt me and ask the question. I'll try to get it answered at the time. So first of all, let's look at ASC 606. It is a standard from both FASB and IFRS entitled Revenue from Contracts with Customers. You may know it as ASU or the Accounting Standards Update 2014-09 or IFRS 15. Basically what it is an update to the current revenue recognition standards. And this is one of the few times, one of the first times that the IASB, who produces the FASB rulings, and the IFRS organization has come together and said, you know, we need to create a standard that's consistent. It does not matter what business you're in, what industry you're in, what geography you're in, what capital market you're in. We need people who are using financial statements, investing in businesses, to be able to look at a set of financial statements where contracts with customers are involved and be able to make business decisions without having to understand standards that apply differently in the UK than they do in North America, US, Canada, Mexico. It doesn't matter. It doesn't matter whether you're in, as I mentioned, different industries, capital markets. Unless you're in the leasing industry, which has its own set of standards. ASC 842 is a new one that's coming out, replacing 840. Insurance or banking. If you have a contract with a customer, ASC 606 will most likely apply to your business. One of the nice things about it, though, is that because it gets rid of a lot of other standards, there's a string of them listed here on the slide that are going away, it basically is going to make your life a lot easier. It reduces the number of requirements. On the flip side of that, it does expand your judgment calls and the disclosures to your financial statements. Current standards such as EITF 08-1, SOP 97-2, which are very common in the hardware software industry, rely very heavily on things like vendor-specific objective evidence, or VSO, third-party evidence, best estimated selling price, the residual method. Most of this is going away. You'll see some similarities as we go through 606, but you won't see those phrases anymore other than the residual method does pop up its head at one point later on. It's going to add some new revenue recognition elements. The current standards talk about deliverables, right? You recognize revenue based upon the deliverable and the timing of that deliverable and so on. That phrase has gone away. It's been replaced with performance obligations. So what are you entitled to do based on the terms of the contract? And we'll get into more detail on all of these. It requires a distinct identification of those performance obligations, not just in terms of what I'm giving to the customer, but actually if I were to pick up and read the contract as well. It adds variable consideration, an extra element there. It talks about the time value of money for certain contracts. So there is a net present value calculation that needs to be done depending upon that contract. And we'll talk again about this in a little more detail. And then the recognition is now no longer dependent upon delivery and expectation of getting paid as we have in the current standard, but it depends on transfer of control. of course, collectability still comes into play. So as we go through, watch for these phrases. You're going to see them come up, in particular as we're going through that 5-step recognition method. What we will find is that with ASC 606, there are a lot less rules. Today's standards are rules-based. When you're reading those, there's a lot of, you must do this, or you cannot do that. With ASC 606, a lot of it is principles-based. It lays out the principle, then gives you the freedom to interpret that to a degree. But when you make that judgment call, when you decide how I'm going to do that, you then have to document and disclose that in your financial statements. And those decisions, those judgments, obviously must tie back to ASC 606. So it's going to require you to understand 606 in more detail. So let's look at a summary of those 5 steps. As I mentioned, we're going to talk about the 5-step methodology. First of all, we need to identify the contract with the customer. Do we even have a contract? Let's talk about that. We're going to identify the performance obligations. We're going to determine the transaction price or the standalone selling price initially, then the transaction price of each of those performance obligations. Then we're going to allocate those transaction prices and then recognize the revenue upon satisfaction. So taking these one at a time, let's talk about identifying the contract. First of all, how do I know whether or not I have a contract with a customer? Well, according to ASC 606, a contract is an agreement between 2 or more parties that creates enforceable rights and obligations. In other words, we have a contract that says I am going to deliver to you a string of goods or services, and in return, you are going to give me, hopefully, some compensation, some consideration. If we have that agreement, we have a contract if you are a customer. This does not apply to partnerships. There's other accounting standards that apply there. This is for customers. In order for it to be a contract, there's certain things that must be in place, and these are not one or the other. All of these must be in place. The agreement must have commercial substance. It must be approved by all parties to the contract. Now, this can be done, according to ASC 606, in a number of ways. It might be something that's done in writing. It may be a purchase order, an actual contract, stamped, signed, sealed, witnessed in front of your lawyers. It might be something as simple as an oral agreement. You know, in some parts of the country, it's still customary to the gentleman's handshake is a contract. So whatever your customary business practice is, if based on that you have an agreement with the customer, as noted above, there's enforceable rights and obligations, then you indeed have a contract. The contract must have identifiable rights regarding the goods and services. What is it that I'm selling you? When am I going to sell it to you? What does it look like? When do you receive it? When do you take control? At what point can you reject it? And on the flip side of that, at what point do you have to pay me for those things? Those have to be in. Those identifiable rights regarding those goods and services. Who's providing them? Who's receiving them? What is the timing of that? There must be specific payment terms. So if you have an agreement with a customer, hey, I'll do this for you, and yeah, you know, pay me sometime, that's not a contract. You cannot recognize that revenue because it is not a contract until your obligation is complete. There must be a probability of collection, and it recommends a threshold of about 70% certainty or probability. So this is important. If you're working with a customer, and you'll notice as we go through this, you have to reassess your contracts over time. Even if your customer is giving you money, but you don't think they're going to give you any more, there may not be a probability of future collections for the balance of the contract. You may have to stop recognizing revenue. You might have cash in your hand, a big old pile of cash, but the customer says, you know what, we're on the verge of bankruptcy. I'm giving you this, but you know, we may not be able to fulfill our obligation for the remainder of this contract. You cannot recognize the revenue that you have in your hand until a couple things happen. Number one, that certainty has to go back above the threshold, or the contract has to terminate. In other words, the guy says, hey, you know what, we're done. We're out of business. We're bankrupt. Great, that contract is terminated. Or on the flip side of that, you say, hey, if you're not going to pay for it, it's done. I'm canceling, terminating the contract. Now you can recognize the revenue. It also states that contract modifications may result in a new contract. So you might have an agreement with somebody to sell them, for example, licenses. Maybe it's so many software licenses or seats, and for a certain price. And 2 years into the 3-year contract, you renegotiate the price with the reason is to incentivize them to buy more, to increase and extend the contract. Well, that might actually result in a termination of your existing contract and a new contract going forward, or, and again, it's all spelled out in 606. We're not going to be able to cover all the details here. It may be that that contract will carry on and the new negotiation is in fact a brand new separate contract. If you have multiple related contracts that are entered into or around the same time, or if one contract is dependent on another, then according to 606, you treat them as a single contract. An example of that might be something that is negotiated as a package. So maybe it's something like a hardware-software deal. I've got a contract to sell you X number of computers, a separate contract to sell you X number of licenses to run on those computers. Now, they may look like separate contracts. They're actually written on 2 different sheets of paper, signed at different times, maybe even by different signing agents or purchasing authorities. However, if they are dependent upon each other, I need hardware to run the software. I need software to run the hardware. They are, in terms of 606, they could be deemed a single contract. So you have to ask yourself those questions. Are they negotiated as a package with a single commercial objective? Does consideration of one depend upon the performance or price of another? In other words, I'm not paying you for item B until you have finished building, designing, creating, delivering item number 1. They might be separate contracts, but in that relationship, they are in fact treated from an accounting standpoint as a single contract. And are the goods and services in effect a single performance obligation? So I'm selling you a system with a service contract. Is it really a single performance obligation? I'm selling you a system guaranteed to run for 3 years? Or is it in fact, here's your package and here's your service contract separate? Again, if there's a dependency, treated as a single contract. Let's talk about where you may have may or may not have a contract and be able to start recognizing revenue. Suppose that you have a conversation with a customer. You have an agreement. There's no signature. You have not yet received a purchase order, but you begin working and the customer gives you an advance payment. Can you recognize that revenue? Well, the answer is maybe. I don't know your business practices. This is where that judgment call comes into play. If it is your normal business practice to always, always, always have a purchase order, and for some reason this was the exception, you did it without it, according to your business practices, you do not yet have a contract with the customer. Therefore, even though he has given you an advance payment, you cannot recognize the revenue. It must be deferred until such time as there is, in fact, a contract in place, and then recognized according to what we're going to discuss here about 606. We talk about the equipment and service contract. Are you selling them as related items? Is one dependent upon the other? So how do you determine the proper accounting treatment? Separate contracts exist if different goods or services are added or the contract price is increased. Now, does that mean it's a new contract? Does it mean it's extension of existing contract? Again, it depends upon your business practices and the interpretation of ASC 606. A lot of these questions don't have hard and fast answers. A change in a contract may impact revenue to the point where you actually have to do a catch-up or a catch-down, a positive or negative adjustment based on what you've recognized in the past as well. So we've identified that we indeed do have contracts. Now, based on what's written in those contracts, do we have performance obligations? Let's see what those are. How do we identify them? A performance obligation is a promise, either explicit or implied, in that contract with a customer to transfer goods or services. Now, it could be one good or service. It could be a series of goods or services over a period of time. If the contract consists of more than one good or service, then they're accounted for separately if they are distinct based on 2 conditions. And again, both of these must apply. The customer can benefit from that performance obligation on its own or with resources readily available to the customer. In other words, let's say you're delivering, again, let's talk about a hardware system, and it's a hardware software. But I mean, the customer can still start to use that hardware even though they don't have your proprietary software yet. You could say, no, that's a performance obligation, that hardware. The customer can benefit from it. They can use it on their own. Therefore, you could start to recognize the revenue from that performance obligation. And each obligation is distinct in terms of the contract. This one is important in how you write your contract. Even writing something as simple as a work order or a sales order. If maybe you don't have long-term contracts. You simply sell systems over the counter. But if you write that system up and say, you've got a system with a 3-year warranty or 3-year service contract for X dollars, you may have just written that in such a way that you have to defer even the value and the revenue from the hardware. Yet if you say, here's a piece of hardware, on one line, on a separate line there is a service contract for 3 years, now you can recognize the revenue for the hardware as that's satisfied on delivery. We're going to talk about what satisfaction means. But you would then defer only the portion for that service contract. So if somebody, the way to look at this is if somebody were to walk into your business that doesn't understand your business and grab one of your contracts and read through it, would they be able to see on that contract that there are in fact distinct performance obligations, distinct obligations that you have to your customer? If that's true, then that's going to change the way you recognize revenue. If it's not, if reading that contract is very ambiguous and you cannot pull out those various performance obligations, then you may be forced to defer recognition of all of your revenue. So it's very important how your contracts are written as well. Now that we've determined that we have, in fact, performance obligations on our contracts, we need to determine the transaction price. So the transaction price is the amount of consideration to which an entity is entitled for transferring the goods or services to the customer. Typically, these are determined at contract inception. However, 606 does require that you reassess your transaction prices at each reporting period. Now, if you're a public company, you have to report quarterly and you've got tens of thousands of contracts, that seems very onerous. That's not the intent. You can do it by contract class. So if you have 10,000 very similar contracts, you can assess it as a portfolio, not each individual contract. This is where variable consideration comes in as well. And there's a new piece here that's not in the current revenue recognition literature. It talks about two methods. It talks about the most likely amount. So if there's some kind of a clause that says, if I meet a certain obligation, I'm going to get this bonus or I'm not. What is most likely? Am I going to get it or am I not going to get it? It's usually all or none. Or there's an estimated or expected amount, which could be a sum of probability weighted amounts. Typically, once you apply one of these methods to a contract, it's used consistently throughout. It's very rare that that would change. If you look in the ASC 606 literature from the IASB, there's actually several examples. There's an appendix in the back that has, I think it's 65 different examples of how different industries and different circumstances with different wrinkles in their contracts would recognize the revenue. Example 21 touches on variable consideration. It gives an example. It says you have a contract for $250 million plus or minus 10K for each day, early or late. Based on an inspection rating at the end of the contract, there is also a bonus of $150,000. So what am I going to recognize? It talks about two different variable amounts here. There's the number one, based on the expectations, I'm going to use the estimated revenue associated with the 250 plus or minus 10 a day. And this may come into play, for example, with there are cases where you can use, very similar to today, in a construction example, your percentage of completion, where you might be recognizing your revenue base this way. Secondly, use the most likely amount for that bonus, because again, it's either all or nothing. So if in doubt, check the examples in the back, because when you're reading through 606, it is complex. It's not written in plain English. It's written by a bunch of accountants and a bunch of lawyers. Some of it is very complex. The examples break it down and distill it so that the rest of us can understand it as well. The transaction price might also include the time value of money. This is also a new feature in the revenue recognition literature. This applies only if it is significant and only if the contract is greater than 1 year. Basically what it means is if I'm getting paid for something today that I don't have to deliver for many months, a year or 18 months, or I do something for my customer today, but I don't expect them to pay for it for more than a year, in effect, it's a loan. I'm lending them some money. So basically what it would say is you then have to treat it as a loan with an income or expense component, depending upon which side of the contract you're on, and whether you're, right, depending on how the accounting goes. And again, it gives some examples. So let's say you have your typical contracts are less than a year, $50,000. Then you end up entering into a contract that's 2 years, but it's $2,000. To me, 2,000 out of 50,000, that's not significant. I wouldn't apply this standard. But if it is a significant amount, then you would have to apply this section of the standard, and you would have to treat it as if it was a loan with that interest component. Well, what rate do you use? Well, it says the prevailing rate in your industry. I don't know what that rate is. That's something that you would have to determine, again, working with your CPAs, your bankers, and so on. But that's what the literature says, the prevailing rate in your industry or geography. 606 also talks about non-cash consideration. So I'm going to do some business for you in exchange for you doing business for me. Or I'll do you a favor, you do me a favor, I'll deliver my goods, I get shares in your company, something like that. It's non-cash. It says treat it at fair value, whatever the fair value is at the contract inception. It does state that if that fair value changes over time, let's say it's shares in your company. I do some business for you in exchange for shares in your company. Over the 3 years that we're doing business, your company goes wildly successful and your share price triples. Well, that's not standard revenue. I have to treat that change in fair value as a gain or a loss, not as revenue or an increase or decrease in revenue. It also talks about consideration payable, such as rebates. It says to treat them as a reduction in revenue unless for a distinct good or service, in which case they would apply directly to that good or service. So I've got my contracts. I can distinctly see my performance obligations. I know what the transaction price is for each of those. Now I have to allocate that transaction price. So this is a tricky part. If I know my transaction price, what is it I'm allocating? Well, what if I've got variable pricing? How do I do a buy one, get one free? You know, you buy this item, I'm going to throw this one in. Obviously, the transaction price might be zero. But in accounting, nothing has a value of zero. So we have to allocate the revenue based on those contract performance obligations. So it says for the transaction price, you have to determine the standalone selling price of each of those performance obligations. So what is the price at which an entity would sell a good or service to a customer separate from all other goods or services? That would be the standalone selling price. So for example, go back to that buy one, get one free. Well, if you were to buy just that free item, what would you pay for it? You're not going to get it for free, right? There would be a price. What would I charge my customer? So that would be its standalone selling price. It's free in this scenario because it's part of that bundle. It's part of that contract that says buy one, I'll give you this one. But the standalone selling price has to be determined. If you cannot directly determine that, then it says to estimate that standalone selling price using all reasonably observable data. Think back to the VSO, the third party, the best estimated selling price standards. It's very similar. It talks about using things like an adjusted market assessment, cost plus margin calculations. And it does state that for those items that are highly variable, right, my sales guys can charge whatever they want, buy one, get one free, pay X dollars, pay 100, pay 0, pay 1,000. It's so variable, it's hard to nail it down. In that case, I would use a residual method. Maybe it's a brand new product. I don't know what the price is yet. I haven't sold it yet, so I don't know what a standalone selling price should be. Again, I would use the residual method after everything else in the contract had been allocated. There is a quote in ASC 606 that I particularly liked, and I've quoted it word for word here when it comes to the transaction price. It says that a contractually stated price, in other words, what's written on your contract, may be but shall not be presumed to be the standalone selling price. So again, there's some judgment involved, there's some investigation involved, and whatever you decide, however you come up with that number, make sure you document it. You must disclose that. Here's an example. Suppose that we had, I'm running a computer business. Very small example, small dollars. I've got this computer system I'm going to sell you. It consists of a computer, a monitor, a keyboard and mouse, and a service contract for 1 year. And I'm going to sell you this thing for $1,000. So I know what my performance obligations are. I've got those 4 elements and they're separate in the contract. Now I have to look at what is their standalone selling price. Well, the standalone selling price of that computer is $700, the monitor $300, the keyboard and mouse $100, and the service contract $100. But I'm going to sell you that entire system, that entire contract is for $1,000. So what I would have to do is reallocate the revenue based on the standalone selling prices of those components. The formula is pretty simple. I take the item's standalone selling price. Let's look at the computer, $700. I divide that by the sum of all the standalone selling prices, $1,200. That gives me its relative weight of that contract. And then I multiply that by the actual selling price, which is $1,000. So even though the standalone selling price of that computer is $700, its revenue is only $583.34. Now, if I'm putting everything to the same revenue account, who really cares, right? I mean, it's $1,000 revenue. Who cares? Well, where it becomes important is, do I recognize the revenue today, or do I have to defer some of it? And this is important because we know a lot of the rules that we follow today are because of the old Enron WorldCom days when people were recognizing stuff up front that should have been deferred and vice versa. Look at that service contract. On paper, on the contract, it's part of that system that I'm selling you. It's a distinct element. It has a standalone selling price of $100. But I'm not going to defer $100. Based on its weighted value, it's $83.33. Now again, that may seem insignificant. 83 bucks. Who cares? The difference is $16 and change. Who cares if I recognize today or defer it? Well, what if this is millions of dollars and I've got tens of thousands of these contracts? Now it's a significant amount, and now it makes a major impact on my financial statements. However, what if, when I look at my contract, I cannot determine that there are, in fact, 4 distinct performance obligations? I'm selling you a system for $1,000. No distinction as to what makes up that system. In that case, they are not distinct performance obligations, and the entire amount, the entire $1,000 would have to be deferred. This is where it becomes very important that your contracts are written properly, that it's very easy for someone to determine those performance obligations and their distinction from each other in the contract, determine those standalone selling prices, and allocate them accordingly. Okay, so I've done all of that. I've got some stuff that I want to recognize now. I've got some stuff that I want to defer. When am I allowed to recognize the revenue? That's step number 5. You recognize the revenue upon satisfaction. So ASC 606 says upon satisfaction of a performance obligation by transferring a promised good or service to the customer, I can recognize the revenue. And it says that a good or service is transferred when or as the customer obtains control of that good or service. It could be something that is done at a point in time. In other words, I'm selling you a blue widget. I hand you the blue widget. You're happy, right? I've done. But now if there's a service contract on that blue widget, now that might be satisfied over time, in which case I have to defer that revenue. And it would be satisfied over time if the performance obligation creates or enhances an asset over time and the customer controls it as it's being changed or enhanced. The performance obligation does not create an asset with an alternative use to the entity providing the good or service. Think of a construction contract. If I'm in the construction business and I'm going to build you a mall or a building or an apartment, whatever, and it's going to take me 6 years to build it, I don't want to recognize my revenue at a point in time. When I finally hand you the keys and walk away, I mean, I'm going to go bankrupt not being able to declare revenue for 6 years. It's not going to look good on my financials. I may have money in the bank, but I can't recognize any of that revenue. This clause lets me out of that. It says the performance does not create an asset with an alternative use. So I'm not in the mall business. I don't want to run the mall. I'm building this thing for you. So you're going to pay me over time. I can recognize over time. And you might use something like the percentage of completion or matching your revenues with your expenses, that kind of thing. That is still part of 606. Or the benefits are received or consumed as the performance takes place. A service contract is a great example of that. You know, you sign, you buy something from me and I sell you a 3-year service contract. Every month that goes by that I either fix that thing and keep it running for you, or it goes by and you don't call me because everything's working fine, I can now recognize the portion of that revenue. So I can do that again over time. So basically, it's when the customer gains control or gains the benefits. Well, what does that mean? When does a customer gain control? And all of these must be in place. When the customer has a present obligation to pay. When the customer has legal ownership or title, has physical possession, has the risks and rewards of ownership, and accepts the performance obligation. That last one is probably the trickiest of the bunch. The customer accepts the performance obligation. This is where a judgment call comes in place. So let's go back to, I deliver something to you and we have a dispute. You're not happy with it. You've got it. You've got an obligation to pay as far as I'm concerned on that contract. You now have legal ownership and title. You've got it in your hands. You're hanging on to it. You get the risks and rewards of ownership, but because of, who knows, shoddy workmanship, dissatisfied customer, someone's just hard to get along with, you decide you're going to file a lawsuit against me for that particular item. Can I recognize the revenue? You know, I'm not answering that. That's where you're going to have to go and have a conversation with your legal team, because technically the customer has not accepted the performance obligation. So there's a little bit of gray area there, and this is where there is some judgment that's required, some documentation, and some disclosure. Where you have to be careful is you don't want to be recognizing revenue if there is the potential for that revenue to be reversed. In other words, the customer, all of those things fit, the customer has it, but they're unhappy with it and they're determining, you know, they might return it. Well, you shouldn't be recognizing the revenue if there's a right to return and you know the customer's unhappy because they have not necessarily accepted the performance obligation. So the 5 steps: identify the contract, identify the performance obligations, determine the transaction price. Based on the standalone selling prices, allocate the transaction prices, and then recognize the revenue upon satisfaction. That, at a high level, distills about 200 pages of ASC 606 into 25 minutes. By no means was that a comprehensive coverage of 606. Don't think that because you've heard this, I'm ready to go. There's a lot of work to do. There's a lot of areas to concern yourself with and to consider. Probably a lot of research to do as well. Let's look at some of the biggest concerns. The first one is timing. If you have not already started to investigate whether your business has to follow ASC 606, you're going to have to start scrambling soon. ASC 606, if you are a public company or a not-for-profit, is effective for fiscal periods beginning after December 15th, 2017. For most companies, that means starting January 1, 2018. Under 11 months from now, ASC 606 applies to you. If you are a private company, you have 1 extra year. Now, you can early adopt. Anybody can early adopt as of December 15th, 2016. You could be doing it today. So if you're good to go, if you're ready, great. If not, you probably want to start looking at it because it's coming up very, very quickly. So timing is the #1 concern. Secondly, what am I actually selling? What do my contracts say? Am I selling a solution or am I selling a number of products? Think back to that computer system. Am I selling you a system, which includes all of these things, but it's just a system, or am I selling you a CPU, a monitor, keyboard, mouse, and a service contract. Or maybe I'm selling you a computer system and a service contract. But again, there's got to be some distinction in order to be able to recognize certain items right away and defer the correct amounts that you can't recognize right away. So beware of items that are not distinct in terms of your contract, especially when it comes to things like service contracts and having them kind of included in with the other items. Materiality. We talked a couple things there. Materiality, when it comes to the timing, the time value of money. If something is small, it's not really worth a contract that says greater than 12 months. What if it's 13 months? And what if it's only $1,000? Well, you know what? That's not material. Don't waste your time on that. $1 million contract contains a single performance obligation of $50,000 or a second performance obligation. Do you need to report that as a separate, even though it's distinct in the contract? You know, it's not really material. For something that small, you wouldn't need to account for it separately. Licensing. There's an entire section in ASC 606 on licensing, and there's different types of licenses. It talks about a right to use, or they call it functional IP, which you would recognize at a point in time. This would be things like software, drug formulas, completed media content, anything like that, where the customer, you sell it to them, and it's theirs. It's good to go, right? Like on-premise software is a good example of that. Or it could be a right to access, or what they call symbolic IP, things that you would recognize over time, brand names, team trade names, logos, franchise rights, that kind of thing. This is a bit of a change for the software industry in particular. It's very possible for software companies now who are under SOP 97-2 have to defer a lot of the revenue costs to recognize the revenue cost for software at the inception of the license, not over the term of the license. That is a big change. If you are listening and in the software industry, talk to your accountants, talk to your CPA, talk to your legal team, and see this might change the way you recognize revenue. Contract reviews. Several times through ASC 606, it talks about periodically reviewing your contracts, your portfolio of contracts. And it could be individually or by portfolio. Each reporting period, if you're a publicly traded company, that means doing some kind of a reevaluation or an inspection at least quarterly. It might be more often for some companies. Do they still fit the definition of a contract? Do they still fit the definition of collectability, and so on? Because that could change. It also talks about the performance obligations need to be reviewed periodically for changes. If your contracts are very volatile, if things change, well, check them for pricing and other changes to make sure that you're still treating them properly. Did you have to do a catch-up? Is it a new contract? Do I change the recognition from here going forward? Do I have to go back to day one? All of that should be reviewed each reporting period. And bear in mind, again, that contract changes can trigger different things to happen. Could trigger a brand new contract. It may require a true-up, either positive or negative, or it might simply just be a change from here forward. So, number one reason that we're on this call today is that we're using Dynamics GP. As we're going through ASC 606 and those steps, the performance obligations, reallocating the transfer price or the transaction price, were you thinking, how am I going to do that? If I put a price on, how do I then reallocate the revenue of those things inside of Dynamics GP? Well, you can't, unless you do it the hard way, which is using Excel. Or you can do it the easy way, which is using an ISV application. And there's a few of them out there. I'm going to talk about the MinerStream products here a little bit today. Let's investigate the options. What if I want to do it in Excel? I don't necessarily need an ISV product. I can do this in Excel, right? I mean, there's a lot of people out there that are really good at Excel. It's a great product for the right purpose. So you could build a complex spreadsheet to do those standalone selling price and reallocations. I mean, it's not that difficult. You saw the formula. It's a very simple formula. I can build that in a spreadsheet, throw my items, my invoices in there, not a problem. Then I have to manually journal entry them back to Dynamics GP to get the right amounts moved from deferred revenue to revenue and so on. The problem is, if you've got more than just a handful of those, it can become very time-consuming, very complex. and it's not really good use of your time. Let me show you an example. I'm going to walk through this just a little bit at a time and think about the timing it would take to do this, not for one, not for 100, but maybe for 1,000 or tens of thousands of contracts. Here's the contract with the customer. I'm going to sell the customer some hardware. There's a setup fee. There's some SaaS or subscription as a service software. There's an annual maintenance contract for 2 years, some professional services, and then I'm going to throw a $1,000 discount on the whole thing. In the second column, under the extended price, we can see the actual transaction price for each of those items. I've also got different billing periods. I'm going to bill the hardware right up front, first period. I'm going to bill the setup fee right up front. The software, obviously, I'm going to bill it monthly. The professionals or the annual maintenance, I'm going to bill it up front but defer it for 12 months. Each time I bill it, I'm going to bill it twice over the 2-year contract. The professional services, there's a couple ways I could do this. I could bill you the $3,000 up front and defer it and recognize it as it's used, or I could bill it as the hours are actually consumed. For the purposes of this one, I'm going to say let's bill it right up front. Based on this, I look at my contract value. I can see my total contract is $214,000. So far, so good. I've determined I have a contract with a customer. I can very clearly see I have distinct, in terms of the contract, performance obligations, and I've determined their transaction price. Now, I have to go and allocate that. So I have to figure out what is the standalone selling price of these items. That $15,000 hardware actually has a standalone selling price of $17,000. The setup fee, I didn't do anything with that. It's got a standalone selling price of $5,000. The software, because this is a 2-year contract, I've actually reduced it from the standalone selling price of $8,000 down to $7,000. But I have to use the $8,000 standalone selling price to reallocate the revenue. The annual maintenance, nothing there, nothing on the professional services. So this one is actually fairly simple. It could be much more complex. But I look at this and go, now my contract standalone selling price is $241,000. My actual contract value is $214,000 with a $1,000 discount. My contract standalone selling price is $241,000. Now, remember the formula that we looked at earlier. I have to reallocate the revenue. I have to take each item's standalone selling price, divide it by the sum of the standalone selling prices, and multiply it by the actual contract price, or the selling price. I reallocate the revenue, and now I can see what my reallocated amount is for both the contract and for each period that I actually bill these particular items. Now, that was a lot of numbers. It was complex. I hope I didn't lose anybody through that, but that was one. What if we had many, many contracts? Let's review again. Where did those period revenues come from, reallocated? What we did was we took that formula, and let's go through the SaaS software. We took the item's standalone selling price of $192,000. We divided it by the total of the standalone selling price is $241,000, multiplied it by the contract value of $214,000 to arrive at $170,489.63. Divide that by the 24 months at $7103.73 per period. Again, that's a lot of work for one contract. If I've got hundreds or thousands, yeah, I can do it in Excel, but it ain't pretty. Now, it gets even more complicated. On the left-hand side is my invoice. I'm going to bill you for these items, the $15,000, the $5,000, the $7,000, the $12,000, the $3,000, and the $1,000 discount. But the revenue that I'm recognizing is based on those other values, that reallocated. So even though I'm going to bill you $41,000, based on 606 reallocation, I can only recognize $39,958.50. On the right-hand side, here's my journal entry. Notice in the red at the very bottom, I have to accrue that difference. In this case, it's $1,041.50. I have to do this exact same calculation every month for the next 24 months of this contract. Now, at the end of the contract, I will have billed you $214,000, and I will have recognized $214,000. But the interim periods, all those interim reporting periods must be accurate as well. This is how you have to do it. You would have to manually calculate those differences and create that journal entry to accrue the difference so that by the end of the contract, everything trues up. As I said, that's the hard way. What's the easy way? Here at Binary Stream, and that's the reason that we've been invited to this call, is that we have applications for Dynamics GP to simplify your life, to make this happen. We have actually 3 different products that fit different parts of ASC 606. They can be used together or they can be used individually inside of Dynamics GP. We have an advanced recurring contract billing, we have an advanced revenue and expense deferrals, and we have a multi-element revenue allocation. Now, the multi-element revenue allocation will work with the advanced recurring contract billing. So basically what's going to happen is we're going to give you in the advanced recurring contract billing either scheduled, monthly, quarterly, and so on, billing, or milestone-based billing. Milestone billing would be like, I'm going to charge you 10% on contract inception, I'm going to charge you 20% upon installation, 30% upon testing, and so on. Kind of hard to lay that on a calendar. So we have a milestone billing module. You get line level control of all of those billing parameters. They can be metered, consumption-based, usage-based, all of that in there as well. True tiered or cumulative pricing. And then on top of that, multi-element revenue allocation will automatically do all of those calculations we saw inside Excel. So you can take your Excel spreadsheets and put them away. We're doing it inside of Dynamics GP. The advanced revenue expense deferral simplifies deferrals either straight line or milestone based as well. We can do our recognition at the line level. The big difference between Dynamics GP's RED or revenue expense deferrals module and our advanced revenue expense deferrals module. In Dynamics GP, you will do your recognition at the distribution level. So how do I defer 2 different items when I've only got maybe 1 deferral account on my balance sheet? How does it know when I create that invoice that $50,000 is for 1 year and $50,000 or $80,000 or $100,000 is for 2 years, for example? I have to manually open the invoice, manually open the distribution, manually allocate the money from that distribution and split it up and say apply this template to this one or this profile and this profile to the other and get to do it that way. A lot of manual intervention. Because we do it at the line level, you can simply sell an item and say, hey, this is the 1-year item, this is a 2-year item. Boom, done. We create the schedules in the background for the correct dollar amount for the correct amount of time, regardless if they go to the same account or not. We don't care about the distributions. There's no need to manually do that allocation of those templates or those profiles. We do not post to future periods. Dynamics GP RED module, if I create a 3-year deferral and process that today, it will create 36 journal entries and post them all today. As I mentioned at the beginning, I've been an accountant for 20 plus years. I have yet to meet another accountant that says, you know what, I love it when my ERP posts 3 years into the future. It just doesn't happen. Accountants are working in this month, maybe next month, but nobody touches my general ledger out beyond that, especially into next year or the following year and so on and so on. We can set it up so if you have a 99-year deferral, we can build a schedule that shows you what that looks like for the entire 99 years, but nothing touches your journal entry or your general ledger, until you want it to. You determine what gets posted and when. And again, it's fully integrated with our advanced recurring contract billing. So that example that we looked at, I can set that up in the advanced recurring contract billing so that my service contract gets properly deferred because ARED talks to ARC-B automatically. And again, the multi-element revenue allocation, this is where I'm going to set and define the SSPs, the standalone selling prices. In today's literature is called the fair value of those items. And I can create those allocation IDs. MEAs have kind of gone away in 606, but this is a way, just the term that we're using to say treat these items as if they are part of the same contract. So if you have different contracts hitting the same invoice, that's not a problem because Mira knows which ones belong together, which ones to allocate together. And basically what it's going to do is take those items, and here's an example of a computer, a mouse, a monitor, a key, and a service contract. This service contract is $1,000, but I can say that the standalone selling price is actually based on a percentage of other items. It's based on the list price. It's based on an amount I'm going to key in. It's based on the amount on the invoice. And if you look in the very, very far right column, it's giving my recognition amount. It's doing all of those calculations that we were doing in Excel automatically inside of Dynamics GP. Quick summary. We reviewed ASC 606. We now know what it is, revenue from contracts with customers. So you should be racking your brain thinking, does this apply to me? Do I have contracts? Do I have to figure out my performance obligations? Are they distinct? What is my transaction price? Do I know my standalone selling prices so I can reallocate the revenue? That's the 5 steps. We went over that 5-step recognition model. We know how to handle ASC 606 and GP. We can do it in Excel, or we can use an ISV solution. ARED, ARCB, Mira, those are the 3 products that we have here at Binary Stream. So I'm going to wrap it up here, see if there's any questions. My contact information is on the screen here on the right-hand side. Certainly feel free to contact me. Obviously, the reason you're on the call today is that you are a customer or a potential customer of the SBS Group. We are a partner of theirs. We work very closely with them. However, they should be your first point of contact. Contact Rick Russo. His information is on the screen as well. But again, any questions on our specific products, certainly feel free to let us know. Check out our website. Check out SBS's website as well. So Chris, I'm going to throw it back to you, see if there are any questions.
Hey Neil, thanks for throwing it back. There aren't any questions at this time, but I just want to thank you, Neil, for presenting. And if anyone does have any questions, like Neil said, you can reach out to Rick Russo either through email or his phone number there, or you can also contact us at info@sbsgroupusa.com, and you can always find more information at our website, like Neil said. So Neil, thank you.
No problem.
And thanks everyone for joining us, and have a great day, everyone.